Everybody. So here we are. We're going live today. We're going live a little later than normal, simply because my morning was busy. And I had an interesting morning today. So I had a conversation with a couple of guys that focus on extremely short-term trading, right? Like day trading. They focus on the futures market more so than the options market. And it made me realize something that I hadn't really discussed yet when it comes to investing and trading, and that is that if you are a long-term investor and trader, you are going to have very different cash flow management, risk management, and investment management. And we're going to discuss that and what I mean by that. So there are several reasons there's a difference, but it also struck me as I was talking with them that I was using the term investor and they were using the term trader. And what I found so interesting about those terms and that terminology was, were they really interchangeable? So we were both using different terms to describe the same thing, but are they really interchangeable? Which got me thinking. And I started to think, well, most people would refer to an investor as somebody who is trading longer term, and they use the term trader as someone that is more short term. So even intermediate term like swing trading, day trading, long-term investor. And I came as I thought about it, what I came to realize was that those terms are completely interchangeable. And I'll tell you why. They both play a vital role within a system. So that system happens to be the system that provides money to small businesses to allow them to grow, right? That's the initial purpose of a stock market or a market in general, is to provide funding so that these small businesses that are either doing like amazing things or are just very successful for other reasons, a necessary product development, something like that, they can't really get the money in a traditional manner. They can't get the money in a traditional manner that a person can, because they're not people yet. Once they turn into giant corporate conglomerates, then they're people. But while you're a small business, you're not a person. Some of you know what I'm talking about, some of you don't. I find that to be quite hilarious. So they both work within this system, and within that system, you have little niches. Some of the system is based on price variations each day, a day trader. Some is based on weekly, right? But you have these huge institutions that have to be profitable on a daily basis in order to be profitable annually. And those same people are the reason that small businesses are able to get funding for growth. Now, while those two kind of groups interplay, you have your long-term investors. And what they do is they buy into companies because they believe in management, they believe in the product or service, and they're looking out 5 to 10 years. And what that does is that provides some stability. So if the world revolved around day trading, Bitcoin and crypto, you would have huge standard deviations in price. It's because it's a speculative market that everybody is just sort of turning things over. And so I remember in 2017 when Bitcoin hit somewhere around 20,000, and I was on a floor with 50 other guys, and I warned that I saw 4,000 to 5,000, and a lot of those guys had a good deal of their money in Bitcoin at the time. And boy, were they mad hearing that. They're pretty emotional over that. Point being, it did fall that far. It fell somewhere between 2,000 and 3,000, which is 90%. So that is what a day trader would produce left to his own devices. Now, you have your swing traders, your intermediate term. They have more volatility, more standard deviation than a long-term trader. And a long-term trader or investor is in there for 5 to 10 years at a time, potentially longer. It really depends on the person and how far out they're looking. Some long-term investors are really interested in generations. they're not interested in years even. They're interested in how many generations until X happens. And those people tend to be in the higher echelon of society because they don't have to necessarily worry very much about day-to-day expenditures or monthly expenses, things like that. So I wanted to clear that up. A trader and an investor, they're all part of the same system. I mean, that would be the same thing as like saying, do you need someone who focuses on tires and someone who focuses on transmissions, or are the only people that matter in the auto industry the people that sell the cars or build the cars? No, they're all part of a system. So, I thought about that, and I wanted to share that with everyone, that investor and trader is a very interchangeable term. Now, to the subject at hand, let's discuss how changing your activity level, right? A day trader obviously has more activity than everybody, must be taken into account as a trader and investor, along with your time frame. So we just discussed long-term, intermediate term, and short-term. We have to be aware of that and how that affects your cash flow management, your risk management, and your investment management. We must also be aware of the activity level. So how quickly you're moving money. These two things have a tremendous effect in truly 80% of the effect of how you're going to manage your cash, manage your risk, and manage your investments. So I'm going to give you a few examples, and we're going to walk through the whys of those examples. So as a value growth investor, a long-term investor / trader, you're going to need to keep more cash on hand than anyone else. So more so than your swing trader, intermediate term, and your day trader, short term. You will need more cash flow at all times. I'll explain why in a second. A swing trader, that's the intermediate term, or investor, is probably more interested in sectors and industries than a long-term trader or a day trader. A day trader is probably scaling in and out of positions at a rate no more than 35 bips. Bips, basis points, simply means 0.35 of 1%. And 0.35 of 1% for a day trader is a very wide standard deviation. Whereas if you were a long-term investor and you were scaling in and out of positions at 0.35 basis points, that wouldn't even be called scaling in and out of the position. What is scaling? Scaling is dollar cost averaging, plain and simple. So if you're a long-term investor and ABC is trading at $10 and you believe it's going to go to $1 and you are trading, $100 at a time, that means your scaling position, what you may do to purchase the bounce from $1 is you may take 10% of your money and put it in at each dollar. So 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. Ultimately, you've just dollar cost averaged or scaled into a buy position at $5. You bought some at 10, you bought some at 1. You scaled in at $5. So every penny above $5 is a profit. Now, I would certainly hope if you were aware it was going to $1, that wouldn't be the way you would scale. But that's what scaling is, and that's what dollar cost averaging is. And all three of those people have to do that, right? But they do it at different levels. Now, let's get started with the first question in hand, which is how much cash you have to keep on hand and why. Very simple. So if you're a long-term investor, / trader, a long-term trader, same thing. You need to have more cash than everyone because you are looking at longer variations. What you're doing is you're saying, look, I don't care about the top 10% of a move, and I don't care about the bottom 10% of a move. What I want is that giant chunk in the middle, that 80%. That should be what a long-term trader and investor is looking for, that big 80%, right? So if you're scaling out and into positions based on that criteria, on the way up, you're going to need to, in that last 10%, because you really don't care about 10% of the top or 10% of the bottom, whereas a swing trader or a day trader would consider that sacrilege, and it would bankrupt him in a day. If he didn't care about 10% moves, he's gone. Those two people don't exist. A long-term investor doesn't care. I try to keep that number closer to 5%, but I always tell everyone, especially when you're getting started, to plan on grabbing that 80%. 10 at the top, 10 at the bottom, we don't care. And so what you're going to do is you're going to build a position or get out of a position based on where you see price going. That's going to protect you from a risk standpoint, okay? You're not taking as much risk when you dollar cost average in. Just like the example I just gave, if you believed price was going from $10 to $1, so what you did was you went all in cash at $10, and then price went against you, and against you in this case would mean up, and it went to $15. You just cost yourself 50% because you thought you knew where the top was. Conversely, if you believe it's going to 1, but it only hits 5 before it runs to 20, and you went into cash at 10, guess what? You just cost yourself how much, everybody? You would have saved 50% on the way down, so you would not have lost that money. You would have put that money back in. You would have had that 50% in cash. You would have put it back in, right? So what is your dollar cost average now? Well, everyone, 750. Your dollar cost average is 750, and it runs to 20. You miss it all because you got out at 10 and it never hit 1. That is why you scale in and out of positions. That's why you dollar cost average. And that is why, as you shorten time frame, a swing trader probably doesn't care about a couple percent. Okay, he's probably not concerned. I always say don't be when it comes to swing trading, which is probably where I feel best. Although I'm not uncomfortable in any situation. I'm not uncomfortable long term, and I'm certainly not uncomfortable short term. Swing trading to me seems the best balance in life. So you're not spending too much time where you're on that screen all day, every day. But at the same time, you're not sitting up there as a long-term investor, really investing an hour a month. In bad times, maybe 2 hours a month. So I find that to be a nice middle. In any case, I always say don't get greedy. If you're within 2% or 3% of where you plan to buy, start scaling in or start scaling out. Day traders, I mean, my goodness, like I said, 35 bips, 0.35 of 1% would be enormous because these guys are moving on minutes, if not seconds. So you could go as low as, honestly, 10 bips, depending on the level of frequency. How high frequency are you? How many trades are you placing? Okay. So that is why you need different cash flow management if you are long-term, intermediate term, or short-term trading and investing. Now, swing traders, intermediate term traders are probably more interested in sectors and industries. Why? In my personal opinion, if you are a long-term trader, indexes are a great place to be. Indexes meaning the S&P 500, the NASDAQ, the Dow, China, Japan, giant indexes, right? Countries, if you will. Now, the U.S., because of our economic size, and also, let's face it, our actual size. I mean, we engulf Europe. How many countries are there versus R1, which I think is sometimes overlooked, but not the point. Point being, I think indexes are the easiest way to be a long-term investor because, after all, what you're really interested in is that 80% chunk. So you don't want to do a ton of evaluation. Like right now, if you know that China is terrible and has declined in price by 70% over the last 20 years, you could just eliminate that, from the system. If you're aware that tech is your mover, you're probably most interested just in the NASDAQ. Whereas if you're an intermediate term or swing trader, the truth is you're probably more interested in what within the NASDAQ is moving so well. because you're willing to do a little more work and you're willing to have a little more activity. So you're going to lean into right now artificial intelligence. If you're a short term or a day trader right now, you're probably leaning into the companies. So your NVIDIAs, your chip companies, a lot of these semiconductor companies are doing really well as well, along with your AI, like your traditional AI NVIDIA type situation. So that is the difference. What you're looking for and what you're looking to control as a long-term investor, you want to have less volatility, so less up and downs, less movement, less work, less effort, less activity than a swing trader who wants a little more. So he probably goes into sectors and industries, and then compared to a day trader investor who really wants a ton of volatility, and that is where he lives, and that is what he loves. Okay, so that I hope explains why, based on the type of investor and trader you are, where you will be investing your money. And then, as a day trader and a short-term trader scales in and out of positions, they're going to keep it really small. Why? This is the simplest thing in the world. If you're a long-term trader and investor, you're looking at long bull markets. So a secular bull market, that means a very large bull market. That is your overall macro market, and it has little cyclical markets inside. Cyclical being a little smaller. I'll explain in a second. Your macro secular bull market right now began in 2009, and it really is still continuing. Now, it's had some secular bears, right? Or cyclical bears. I'm sorry. We're in a secular bull. We've had some cyclical bears, one that we just came out of, okay, which started December 2021. I don't remember when the price dropped, but I remember when trading activity was up 500% in December of 2021. So for me, that's when it began, and it ended in October. I can't remember the date, 23rd, 17th, something like that. But that was a cyclical bear inside a secular bull. And if you are a long-term investor, all you're looking to do is miss those cyclical bears. So those traditionally happen once every 4 years. That's it. That's what you're looking for. So you're going to have a wider range, right? You don't care about 10% in either direction. Big range. A swing trader, on the other hand, who's probably looking at 2-year charts, is looking to miss any move down that probably would equate to 5% or more. He's going to want to avoid that, all day, every day. And that swing trading is a loose terminology. Some people will tell you it's as short as 3 days. Some people will tell you it's as long as 2 weeks. I always considered a swing trader somebody who kept their activity level somewhere around 10 trading days, 2 weeks at a time. You're making moves here and there. In my opinion, a swing trader has the ability to run half of his money in a long-term basis to help out with the tax situation, and then the other half of his money he's running on a short-term situation. So he probably doesn't mind 3% in either direction. So long-term investor doesn't mind 10% in either direction. Swing trader, intermediate term, probably about 3%. Does not matter to him in either direction. And then you get down to your day trader, who's at less than half of 1%, is probably the standard deviation that he's comfortable with, simply because how much can a stock actually, if they're trading stocks, we just discussed that. That's their investment of choice. Traditionally, it could be commodities, it could be futures, which move very fast as well. But for the average person out there, you're probably looking at stocks. What's it really going to move inside of, say, 5 minutes? 0.5% will be a monstrous move. 0.35% would be a monstrous move in 5 minutes. So I think that kind of explains it, right? I think that brings that together. So what do we learn today? One, investors and traders are the exact same thing. They're working within the same system, keeping that system moving and functioning for everyone involved in that system. So the terminology is interchangeable. We learned that cash management is dependent upon the level of activity and the time frame that investor is working with, whether it be long-term, short-term, or intermediate term. We learned that investment management is significantly different, whether you're long-term, intermediate term, or short-term, because we want to limit volatility as we shorten time frame. We also learned that when it comes to risk management, you will get tighter with your risk management as time frame shrinks. So you'll go from I don't care about 10% to I don't care about 3% to I don't care about 0.35, which some would argue is a little high percent based on that day trader. So I'm going to wrap it up there for today. I hope you enjoyed that. I did. And I really hadn't thought about this conversation until my conversation this morning. So I was happy that I had that busy morning. In any case, as always, for anyone out there struggling with mental health, we're here for you. Everything is going to be okay. I promise you. Tomorrow will be a better day. Find something to smile about, right? Find something that makes you laugh. Do anything. Even if you have to fake that smile until it becomes real, do what you have to do because it will be a better day. Every day above ground is a good day.